Okay, awesome. So what we're going to do today is I'm going to take you through some of the core innovation and the technology of the Solana network. Just what makes it fast, what makes it stand out, what is some of the engineering that goes behind building sort of public blockchain infrastructure that just works, right? And why, therefore, it is the right place for someone to, or at least the right frame for someone to evaluate when they're thinking about building a business on there. If you're an enterprise thinking of implementing it in your products or issuing assets on there, how should you evaluate the network per se, right? Because the asset is different from the network, like we spoke about. And so how do you evaluate the network, right? That's broadly what we'll try and go through. So we'll break this into three parts. First, we'll talk about what is the state of the Solana network in production today, right? So before we talk about why it's so awesome, we'll first look in hard numbers that is it in fact awesome in production or not? Because one of the problems a lot of people face is that all of these are white paper claims. They work under lab conditions. They don't really work. Is it live in production or not? And so we'll just look at just fact, just numbers. Then we'll sort of move on to, okay, why is it fast, right? What did Solana do differently that has given it this edge? And then what is the roadmap forward? And where do the engineers working on the network see it going to in the future, right? So with that, if you look at slide number 3, it sort of has the metrics for Solana in production today, right? You can see on like a pure sort of transactions per second basis, it's not comparable to existing blockchains, right? Like Ethereum does 19 transactions per second in production. Solana does easily over 1,000 transactions per second. The theoretical maximum for Solana today is 65,000. It's done 100,000 in bursts as well. And it's so therefore better to compare it with, let's say, Visa or NASDAQ, which do like, Visa does 1,800 transactions per second, NASDAQ does a little more, and they can, of course, process a lot more transactions, right? And so Solana is, as of today, competing with those, financial network or infrastructures rather than the other blockchains that are out there. Same thing goes on active addresses and transactions. If you look at the table on the right, just in the month of July, I think Solana has done that's 3.5 trillion transactions, I think, which is basically somebody signing a message and sending a transaction over the network. In terms of active addresses, which is which I think is an address that has paid fees on Solana, is like 100 billion plus, which is more than twice the network right after it, right? So the main takeaway from this is just that if you compare it with what is live in production today, right, sort of product, not promises, this is where the state of things stand from like a network point of view, right? The next thing then becomes, okay, is this decentralized or not, right? How, because sort of a blockchain network is supposed to have validators. What is the state of validators, right? So if you play the clip that's in the fourth slide, you'll see that there are a little under 1,000 as of now, 986 validators. And you can see in real time every 400 milliseconds or every, with sort of the slot time it's called, there's a new validator that is the leader that is sort of processing blocks. And these are pinging all over the world, right? You can go to this website. It's called solanabeach.io. You can go there and look at it in real time and see that there are in fact like 1,000 distributed nodes that are running this network up. So it's not, because obviously one database can do way more, right? And that's why Visa, NASDAQ, etc. have such high throughput right now. If you have a single entity that owns the infrastructure, that's not the case here, right? And so it's sort of performance with decentralization. And the third metric for decentralization is like, are you spread across different countries and are you spread across different data providers, right? And so because one of the risks becomes that, as a country, especially in the global environment we're in, you sort of tend to think of, I don't want to use, technology from country XYZ, right? I want my own technology. I don't want to be dependent. And this sort of shows that, you've got validators across Germany, the US, Netherlands, UK, a bunch of countries, the top 10, and the stake percentages as well, because this is a proof of stake network, right? And so you can see stake distribution is also spread across the world, which means that no single country as of today can control the network, even if they want to. The same goes for data center providers who are running these validators, because the other risk that people don't realize is that You could be decentralized on every other level, but if everything is running on AWS or on one service provider, they can shut you down, right? And so you can see the sort of number of service providers as well who are
I have a
running this.
question here, which is
Yeah.
why is Germany so disproportionately high? Like, I'd never imagined Germany would have such a high stake percentage. I would always think, okay, it's either the US or people are trying to do it in the Middle East, or maybe, as they say, the Nordic countries because they're colder, which is why it's easier. It's more energy efficient to run the kind of computing software and hardware required to do all this computing for blockchain software. But I never imagined Germany, which is essentially a lot of old people in today's day and age, to actually have so much stake. Any insight or reason behind it?
Honestly, I'm not sure either. A lot of this is just, sort of representation of market forces. Like people, I think you need two things, right? You need an environment where institutions, and when I say institutions, I mean like enterprises that are deploying software or capital, feel comfortable owning and holding stake, right? If you look at both this table and the previous image, you'll see that there is no country, no matter how much they use the network, there's no country where there are unclear regulations that has a lot of stake, because most of the stake comes from institutions that are either holding the asset, trading, or deploying infrastructure on it. And so one is that maybe there is just clearer framework in some of these countries to sort of hold and hold and acquire and have the stake. But it's also just a function of where the early teams are. If there's a strong engineering culture, if there's a strong infrastructure culture, someone just decided to go set it up. That's sort of probably why, and this will keep changing, especially with like the digital asset treasury companies coming up as markets open up their regulation around the tax treatment for your staking rewards and things like that. You may see this thing change, but as of now, I don't have any unique insight on why it's Germany as the highest stake. I do know that there are a lot of amazing teams and developers there doing stuff on Solana, and so there's some of them have just chosen to sort of set it up and acquire stake.
And despite India having possibly the highest number of users of crypto, you still don't see it anywhere in
Yeah.
the top list. I mean, you can imagine it's possibly less than, I'm taking a guess, it would be lesser than 1%, lesser than 0.5% maybe.
I mean, there's no validators in India, right? If you go back to the because if you go back to the validator chart on the previous slide,
Yeah.
you see that on that graph,
Nothing.
there's no dot on India right now. Because again, right, you have, I mean, you need to make like you need to have a setup where you have stake and you're running this and you're getting staking rewards. And I don't think the framework exists right now, or someone needs to underwrite that risk and go create that framework with the regulator and say that this is what I'm doing, and under what entity and framework will this be regulated. So as of now, yeah, that is the bigger threat. When you say that you don't want to use someone else's technology, you then need to encourage people to set up validators and stake here, because your stake is sort of your defense, right? This may also happen through treaties, by the way. You know how you have, this is just like a thought experiment, but the way you have defense treaties between countries, you may have stake voting treaties where you say that we'll pool our stake together, because even though we can't acquire 20% as one country,
Yeah.
the three of us have enough, because those will become the lines of defense, right? When in case of the big tech giants today, you very clearly have to protect against one country where they're all incorporated, right? That's not going to be the case with these networks. And so I genuinely believe the answer is not build your own blockchain. The answer is claim stake in global blockchains where action is happening, right? Get your developers on them, get validators on them, acquire stake in them,
And is there a
and build
reason
up.
that if you look at Asia, I mean, I can see it's all either in Singapore or a little bit in Japan, and I believe the little bit of staking that we are seeing at the bottom of China is possibly Hong Kong as a financial center, which means China, with all its might and technology, is still not adopting to this for some reason. And you think it's because they think it's going to go against national incentives and how the government would want to run it? Is that what it is?
Again, I'm not sure because it's very hard to know, right? Like it's probably that, but I honestly don't know.
Maybe the Chinese are doing it quite like the Indians in different countries of the world. So if they want to be in it, they're like
Yeah.
outside of.
No, for sure, for sure. Many of them have chosen to go to other markets where it's easier to do this.
Got it.
Okay. So again, right, and to sort of close this section out, if you go to the next slide, you'll see that Visa sort of recognized, the Solana network as not just cheap, which it is, but it's predictably cheap, right? And so it is, because if you're choosing to build infrastructure, you can't have fee spikes, right? If you look at the chart on the right, the you have three lines on there. One of them is the fees that you have to pay for, sort of transacting on Bitcoin. One is the fees for transacting on Ethereum. The third line that's almost merged in with the x-axis is the fee for transacting on Solana, right? And so it's orders of magnitude, like less than a cent, and predictably so for reasons that we'll sort of get into now, right? And so this is the state of things as they stand in production today, right? Again, this is not to put down other networks. It's just to say that over the last 5 years, there have been deliberate, design decisions that the Solana engineering team made, the Solana founders made, that led to these outcomes that were very contrarian at the time, but have paid off so far. And of course, others will compete and others may catch up. And now it's all about execution, right? But this is where things stand as of today. With that context in mind, we go to the next bit on, okay, why is it so fast and cheap? What did they do differently, right? This is a network that was founded in 2018, launched in 2020 by Anatoly and Raj. Anatoly was an engineer at Qualcomm, and he worked on distributed systems and managing time and state between distributed systems in Qualcomm, right? And so it's those insights that have informed a pretty unique design for the network, which is, as you can see on this slide, it sort of, the key innovation was to be able to do parallelization without fragmenting the state, right? And if you think of this on a timeline, right? So you had Bitcoin launched in 2009. It said that, okay, you have a unit of account that you can manage on a distributed system, can't do anything else, right? That was a feature, and they've sort of stuck to that so far. Then Ethereum came in and they invented and pioneered, to their credit, what we know as smart contracts or general purpose blockchains, right? They said, why just do one unit of account? We'll make it general, any code, anything can run on this distributed network. The problem was the way it was engineered, it was slow. And so the approach that people took was, they said, okay, let the base layer be slow. There's something called the blockchain trilemma, which is not real, but it was sort of believed at the time to be real. That there's a trade-off between security, speed, and decentralization. I think those were the three, right? It was
Why so? Why would people think so?
So the argument made by Vitalik, who built Ethereum, was that if you try to make it scalable, you will sort of compromise on security. If you try to make it too fast, you'll compromise on decentralization, right? And I'll sort of get to that trade-off in a moment. But this was the popular wisdom, and so therefore the EVM, the Ethereum machine, was a single-threaded machine. It would process one transaction at a time, right? And what Solana sort of pioneered in 2020 when it went live was to be able to do parallel processing, right? And you can see on the next image,
It's almost like the logo of Solana is also built in a way to show parallel processing is, or maybe I'm just looking into it a little too much.
No, it is. You can look at it. If you go to I think solana.com/branding or branding guidelines, you'll see some references to that. But that was the thing they invented. They said that you can do parallel processing on a general purpose blockchain without compromising decentralization. It was heavily criticized at the time because the approach to scaling blockchains that was believed to work at back in 2020 was to add layers, right? Layer 2, layer 3, to keep the base layer as it is, let it be slow, let it be secure, and add more layers on top. And there was also a very self-serving narrative because a lot of L2s, not all of them, a lot of L2s could just launch tokens, not have a product, raise money, and then disappear. And given the funding environment back then, VCs were happy to fund it, and so it fueled that fire. But I genuinely believe there are a lot of engineers who are still trying to make L2s work, and there are a lot of L2s that are doing well and are competing again. Right? It's just about how it's played out so far.
I have a question here, which is that, I believe Ethereum forked at some point, correct? And they said that this forking or this new parallel Ethereum platform, which is now started, kind of solves certain problems that the previous version had. So don't you think similar forking can be done by Bitcoin and Ethereum in the future to solve all of their existing problems and then come at the same parity or level as Solana? Or do you think similarly there could be certain issues which may arise with Solana as we go forward, because this is only evolving as a technology, and as more use cases of finance start coming onto the blockchain, you might see something which is even better technology. So I think as a non-techie, my question is more around how opaque or how low on malleability is the white paper and the initial code that you can't make these changes, and it kind of uh, probably does not make it a lot more secure. I
Yeah.
don't know if I've
No, no, no. This
articulated
is a
well
great
enough.
question. Great question. So I'll try and answer it the best I understand it. Again, I'm not an engineer doing this myself. This is my engineering adjacent understanding of this. But so the fork was different actually. Ethereum forked for a different reason. I think what you're referring to is the switch from proof of work to proof of stake,
Correct.
right?
Yes,
Correct.
I'm speaking to
And
I'm speaking about the switch. Correct.
yes, correct. And that was, I mean, that was good, which is why it's a proof of stake network, but it's still a single threaded network, right? It didn't fix that. So, yes, going from proof of work to proof of stake reduces the energy requirements on the network, because in proof of work, everyone competes to produce the next block and only one does, and so all the other blocks are wasted. In proof of stake, you appoint a leader based on the stake and the schedule, and so only one person produces the block, and so it's more to do with it. It does make it faster that way potentially, but it doesn't solve the problem of being single threaded, right? And so that specific upgrade did not change these all of these metrics I showed you are post upgrade, right? So it still stands there. uh, I think recently Ethereum has acknowledged, the Ethereum Foundation has acknowledged that they want to scale the layer one, right? And so it is very possible, because everything that Solana has implemented is open source. It's out there, right? You can take it, copy it, and deploy it. It's just a question of willingness and maybe, like technical debt or nuances. It's either organizational debt, technical debt, or cultural debt, right? If you spend 8 years saying that the base layer has to be slow, scale the layer two, it's a big switch to make. There's also engineering debt to solve. And so, theoretically, can they do it? Yes. In fact, a place where it may end up happening is on something called quantum resistance. And so, as you know, people have said that, quantum computers might be able to hack and break into, crypto networks, right? They can, just like they can hack your banking password, they may be able to hack your wallets, and that is a real threat. And it is possible that, the Bitcoin network, Ethereum network, Solana network, all the networks have to undergo a hard fork or have to have quantum proof addresses that support it. And so there are updates that can be made and are being made. But I think just going by what has happened so far, there doesn't seem to be a willingness to acknowledge or implement these at any speed as of now.
Got it.
Maybe that changes. But if you also come to the specific trade-off and why this was contrarian, right? So one of the values which is very, very commendable that Ethereum had was that anyone should be able to run a validator, right? We should keep the requirements on the validator so low that you can run a validator like an app on your phone. You can run a validator on a smart device like a TV, like minimize the hardware requirements, reduce the cost, so you maximize decentralization, right? I think this was broadly what their belief was, and therefore their validator client was simple enough to be single threaded so that it can run on the lowest spec hardware. Whereas if you look at the next slide, sort of Solana took a bet on something called Moore's law, which is to say that we have a higher hardware requirement today, which means the cost of running a validator is higher, right? Which means that not everybody can run a validator. But we are betting on the fact that hardware will get better and cheaper and faster. And as the network grows, eventually the costs will go down and we will be decentralized, right? And that thesis played out because, with the AI computing requirements, with GPUs becoming, exploding in production, with Moore's law playing out as it does, you're seeing that keeping the network performant brought in brought in economic activity that justified paying the high price for the validator, but B, the price for the validator, at least the hardware elements of it, are going down with Moore's law. Right? That was the fundamental trade-off, and that's why Solana was initially called, you're not decentralized enough, you're breaking the trilemma, you can't break the trilemma, because your hardware requirements are too high. Not everybody can run a validator, and so few for-profit entities will corner the network, run all the validators, and sort of do it. And that's not in fact, I think it's played out the opposite way, where there are, as of now, 4 or 5 entities that own majority of the staked ETH, whereas there are 25, 26 entities that form what we call a super minority, that can sort of collude. It would take, you can see this in real time on the Solana Beach website, but I think it would take, as of now, 20 plus independent corporate entities to collude to take over the network, right? And so you're sort of betting on pushing that number higher and higher and preventing collusion in that way. So that was, fundamentally the first thing that, that was done differently, very contrarian bet, that made the network fast and cheap at the layer 1 itself, right? Now, okay, this launched in 2020. From then to now, it's not like, they stopped doing engineering stuff. So we talk about what happened after they launched, right? And so if you've just been following, crypto from the news sphere, you would have seen a lot of headlines that Solana keeps going down, right? And this was true. If you go to slide number 13, the next slide, you'll see low fees make you a magnet for spam, right? And this is the uptime chart of the network. You see a lot of yellow and red dots because the network was so cheap. It cost less than a fraction of a cent to send a transaction. I could write a script for $10 and send like hundreds of thousands of transactions, not with malicious intent. Let's say there's a token launch, a mint, a trade. I just wrote a bot that keeps spamming my transaction in.
You're optimizing for volume for whatever reason. You can do it on Solana, but you can't do it on the others.
Exactly. It isn't even optimizing for volume. You're optimizing for access. Like, there's to be these NFT mints where, let's say, 10,000 NFTs are minting for one Sol, and that is by a good team, it's going to pump or whatever, and you want to buy it. And they would do these open mints where you have to just go click buy at midnight or something, right? It's crazy time.
You're decentralizing at a retail level that even smaller people,
Yes,
lower pocket sizes can
anyone
network and get
anyone could write a script to go and buy, right? Whereas if every transaction costs $5 or $50, like it often does on the Ethereum L1, then you can't. There's a cost to spam, right? And so that was essentially what ended up happening, where it was so cheap and widely usable that it then became unusable when it got spammed, right?
Do you think, it's almost like I'm thinking of everything that helps scale and give access to retail investors and smaller players is almost like a B2C company, and everything which is low on access also over the long term tends to have a lot more trust and ends up going the B2B route. So do you think with Ethereum's positioning being more around smart contracts and stuff, you may have legitimate larger companies entering into contracts on the Ethereum network, and then companies which want to build B2C products coming onto building on Solana because they think it just makes better sense. So it's like Ethereum is now like an Oracle or like a giant, and you guys could be, for the lack of a better example, could be something like a Zoho, which is giving a lot more access to smaller entities to kind of come into the network.
I think so. First of all, this is an argument that is made a lot, right?
Yeah.
Like that Ethereum is the enterprise chain. It's so secure that is where enterprises will have value, right? I guess the first question is, if your stake is concentrated within a few entities, are you that secure, and will enterprises trust it or not? That is, maybe okay, it'll rebalance out, etc. Keeping that aside, there's sort of an analogy between BlackBerry versus Apple, in the sense that yes, you had like BlackBerry was supposed to be the secure corporate messenger, and WhatsApp and Apple were supposed to be the retail use case. And over time, those products got so good and ubiquitous that they just became like,
You.
who uses a custom messenger anymore, right? That is one way. But the other way it could go is like Excel versus Google Sheets, right? Wherein you have like Microsoft has this enterprise software that is deployed and so sticky that, Slack might have had a few years of lead time, but when Teams launched, they just like overnight, by just onboarding all the employees, like thousands of employees in these companies, they were able to get that access. And so it is possible. Like the argument falls both ways, that if Ethereum does prove to be more secure from a settlement point of view, enterprises might use it. The problem though there is that as a network, you don't capture a lot of value from just doing settlement, right? Like if you're only used as an external database for an organization, how much would they pay you, right? They would think of you as a service provider, and they would want to, what is the cost of that security, right? Which then is like, is your ambitions as Ethereum would be way more than that, and you would want to compete for being the transaction layer. Whereas, if you are the place where transactions are happening, you end up paying a fee to transact, to get, price discovery to get your order in. And so that argument is there. I personally think that I'm not sure what the value proposition is, but it'll play out, right? It'll play out because Ethereum is improving as well, and these things change really fast. So it is definitely an angle that is very, very much out there, and we just have to see how it goes.
Wow. Okay.
Yeah. So, okay, so this is like the uptime chart for Solana from January 22 to October 2024, right? You can see there's a lot of outages and downtimes. All the reds and yellows is basically times when the network was not usable because of some NFT mint, some spam. And so there's three things that, Solana did to sort of overcome this, right? The first one is something called priority fees. So if you go to the next slide, you'll see the red line is the median fee, and the blue line is a priority fee, right? This is effectively saying that if you want your transaction to go through first, you pay a variable fee, right, for the transaction. So the base fee remains cheap, but you add in a variable fee and say that if you really want to get your transaction, just pay more, and you don't need to spam the network then, right? And so then automatically you have market-based price discovery, wherein anyone who is going to make a bigger profit from a transaction pays more, right?
So it's
That
a
was the first one.
bid-based variable. Like it's just
That's right.
market
That's
determined.
right. Exactly. Right. So that was the first one. And you can look at the.
But can you, like, I know I'm a non-techie, so a lot of these questions will be pretty ridiculous, and maybe the answer is very obvious to techies. Is, can you change the technology after writing the white paper, which is kind of like set in stone, as they say for Bitcoin, the white paper is such that you can't have more than an X number of Bitcoin ever, and you can never change that. The very fact that you can also change the technology is both a strength, but at the same time, does it also not take away comfort from the technology to say, okay, it's really changing with the times and with the use case, but at some point you also feel that, okay, there is someone at the Solana Foundation or at the entity who took this decision to now change the things, and suddenly everyone had that level of trust, thinking that this is decentralized, but all these technology related changes are not necessarily decentralized, right?
So that's a brilliant question. Okay, first of all, great question.
Yeah.
And it does come down to who makes the decision, right?
Yeah.
So let's sort of frame it this way. If something changes on Instagram or YouTube, one person has effectively made the decision, who is, okay, of course it's not one person, it's like some manager, CEO, board, but it's one corporate entity.
Say Adam Mosseri on behalf of Meta as the head of Instagram is taking that today.
Correct, right? And that is the trust, that is the arc of trust you have. In this case, right, validators have something called a validator client, which is a piece of software that the validators need to run. So the graph that you saw is like, imagine you have purchased hardware and you have taken software which is free and open source from someone who has written it. It's called a validator client, and you are running that software. Now, when the person who has written it chooses to push a software upgrade, it is up to you to decide whether you want to accept it or not, right? So in this case, what happens is that you have multiple validator clients. So you have multiple teams that are writing non-conflicting software, but different software for running validators. And B, you need to get all the validators to agree to accept the upgrade, or at least majority of the validators to agree to accept the upgrade. Otherwise, the change will not go through and it'll have to be rolled back, right? So
Oh,
in this case, yeah. So in this case, there is a team called Anza, right, which is part of has a lot of the original engineers who built Solana, new engineers. It's called Anza Research. They are one of the teams that work on the development of the network. When they push out an upgrade, right, they have to communicate to the validators through Discord channel, forum, email, Twitter, somehow, and say, hey, please accept this upgrade, right? And so the validators can legitimately say yes or no, and only if a certain percentage of stake, not a number of validators, certain percentage of stake chooses to accept the upgrade, does that become the dominant client and way things work. And keep in mind, these validators have bought Sol, they have a stake in the network, they have relationships with apps, they want the network to do well. And so you need to pass their test. You need to convince them before the upgrade goes out. And so here you have two things happen. One is that these upgrades have to be socialized. You can't just make an upgrade that people disagree with. These are smart actors. And B, you have multiple people, as we'll talk about later. You have multiple teams writing their own validator clients. Of course, they have to be compatible with the underlying network, but they can choose to write them in different ways. And so you can pick and choose which validator client you want to deploy software from as well.
but here, tell me the next obvious question that comes to me from a business perspective is that these validator clients are essentially then in the business of making software upgrades and selling them to users in the market to say that if you use my software, I as a validator client should be compensated for having put in the effort to create an upgrade, right? Now, quite like how it happens with Apple. Um, there's a new model which has come up, and now while they would say that you can choose your update or not, I am as an end user, after about a couple of months, the environment is created in to such a degree that I have no option left but to upgrade because something stops working or I realize they've unlocked certain features. And the moment I do that, my phone begins to slow down and it's almost like planned obsolescence. Correct?
Yeah.
So if there is inherent motivation to make money by the validator clients, their job would be to keep also plan their obsolescence in a way so that the business keeps growing. And then you're kind of, when you're locked in on a system, quite like if you're locked in on the Apple ecosystem, you're like, oh God, now I can't think of moving to maybe Android, while I may have a lot more option on what software to run on it,
Yep.
but it's so sticky. It's so difficult.
So again, great question. There are three things here. One is that crypto incentives work differently from big tech platforms, right? When Apple is pushing an upgrade, they want to maximize iPhone sales as they should, and they can push whatever updates they want to your phone without you knowing as well, right? Like your automatic updates, backdoor, whatever. I don't know if they do it or not, but they can, I would assume. In this case, one, you own the hardware, right? So once you have a version installed, that person cannot change it or upgrade it until you allow it. And you have to accept that upgrade explicitly, right? It's not that easy to get a backdoor. Of course you can, but you can spot it because you're running it on your hardware. Here, in this case, in Apple's case, like vertically integrated, right? You can't see what's happening inside the iPhone. In this case, you can. So there's one layer of separation there. The second is that both the person writing the client and the person running it own Sol, right? They own the network asset. So they would rather have, what is it called? Enlightened self-interest to work together to maximize value accrual to the Sol asset and both do well, right? At least when we're in the growth phase right now. And the third is that you have the Solana Foundation. I think that will always have one open source client that you can use for free so that the baseline is set. Sort of no matter what happens, one client will be free, easy to use, and so you don't have too many bad actors. Fourth is that, like I said, there are multiple teams competing here for the same piece of hardware. So it's not as much of a lock-in because the sort of hardware is owned separately. Multiple teams are competing to write software, and so we're not at that stage yet. Maybe it happens and you have defenses against it, but as of now, everyone's just invested in, it's like after 16 years of crypto being called rat poison, you finally have a time when it's like legal and you can do things at least in some parts of the world, and so people are just happy to grow the pie within a network for now. I think, and of course you have to keep an eye out. You have to have defenses up. But like as of now, I think that is
I do have more questions, but I think I'll just mention it here, and maybe you can
yeah,
park this
sure.
to answer it later at a better time. Is that when you mentioned that there is voting by validators
Yeah,
to accept an update or not, um, quite like how we saw concentration in Germany and the US, and even when we see it in, say, like a Singapore or a Hong Kong, I would assume a lot of these are now institutions and not necessarily individuals. Because if you're validating, you would put up a setup which is sufficient hardware and computing capabilities and whatnot.
that's right.
And over a period of time, as more of this starts getting the blessings of different governments and banks start coming onto it, again, it may so happen that from a percentage of um, a validator point of view or stake perspective, you may have a lot of institutions owning it, right? And quite
Yep.
like how there is vote bank politics and people figure out how to navigate it. That is a possibility here, but maybe that's a problem for people to think of when the uh, when the use case grows large enough and the pie is large enough for those maybe better problems to have, I would assume.
It's a brilliant question, and I'll answer it in two slides. There's an answer for this.
Okay.
So two slides down. Okay. So to solve the spam problem, three things, right? First one was priority fees. So you pay more to get a transaction through. So even if spam comes, you won't pay too much to spam. And so the people who are trying to genuinely send a transaction through, like good actors paying more for it, would sort of go through, right? The second thing it did, which you see on the next slide, is local fee markets for predictable pricing, right? And this is actually pretty cool, wherein it's almost like surge pricing on your taxi apps, right? Where they say that if a certain part of the network, certain contract, certain asset, certain account has a spike in demand, only transactions that are trying to access that part of the network have to have face a higher fee. The rest of the network can go through as is, and so you have a little bit more predictability in your pricing. If I remember correctly, I think this was a concept Solana copied and implemented from Ethereum. I think Ethereum already has this. I'm not sure. No, actually, they don't. I think somewhere else maybe it was talked about from there, because as you can see, Ethereum, other gas-based networks have global fee markets. I think somebody had this and Solana implemented it, and it's worked really well in terms of separating out the parts of the network that face fees fee spikes. And then the next slide is something called stake weighted quality of service, right? And this kind of answers your question. So when you're trying to send in a transaction, the odds of your transaction getting in now depend on how much stake the validator has, the validator that you're sending the transaction through has, right? Right? Makes sense? So you have, as you saw on that GIF, you have leader rotation. And so if you're an application, you use something called an RPC, which is like an API gateway, which sends a transaction to the leader, right? Now, obviously, even the RPCs would try to spam the leader and try to send as many transactions. So they have something called staked connections, where the RPC ties up with a local validator to become a trusted RPC. And the more stake you have, the better the odds of your transaction going in, right?
Got it.
Therefore, anybody running an app on Solana or anybody running a RPC on Solana is incentivized to acquire stake and acquire their own validator, or partner up with a validator that has high stake. As a result, if you go to solanabeach.io and look at the validators, you'll start seeing increasingly more and more of the biggest apps on Solana are running the biggest validators. So Helios, Jupiter, Squads, I think there's more of these. These are all apps and products that people use, right? So at least the first class of teams that you have that are economically and from a business perspective incentivized to have high stake and run validators are apps built on Solana. So they're not aligned. Of course, they'll be incorporated in some of the other country, but they're not that aligned with one country as much as they are with the network. Like, these are people who believe that the network should be usable, accessible, and open to everyone, and will likely resist you know, geospecific demands to sort of censor or do any of these things. Of course, like you said, over time, when institutions realize that okay, they want to use this network, they will start acquiring stake, and they will. It's what we said earlier, right? You'll start having stake-based censorship that people might try, and so competitively, people will then try to acquire or make these treaties and deals so that you don't get censored by somebody else's stake. Wherein this is basically, as it's on the next slide, basically market solves, right? This is a very difficult problem in economics and engineering design for the people writing these clients to design it in a way that the network is usable by people who want to accrue value to it and do good things on it, and not usable for people who want to spam it. And you can see, since these changes being implemented October 2024 till September 25 is been all green, right? There's basically been no major downtime or outage for, I think, 12 months. This is like 12 months, but even more than that. I think few more months past that, there's been no major outage or downtime, right? So this is since launch till now. These are some of like the big things that the teams have done. But now we come to what is the future roadmap, right? Where does this go? How does this speak? The short answer is, and this is articulated by Tolly, where he says that the only thing that constrains the speed of a network should be the speed of data around the world. It should not be software, it should not be hardware, it should just be the physical time, like physics. Like if you have these undersea cables that give you internet, right? And so it should only be the latency of data going from New York to London to Hong Kong to Mumbai to UAE through these cables, right? And so as of now, that is 120 milliseconds. And so, which is why you have, if when you keep hearing HFT firms co-locate with an exchange, they co-locate so that they're only restricted by the physical fiber that connects them to it, right? And so the beauty of the engineering problem is that he wants to make a distributed system work at the speed of a single system, restricted only by the speed of data around the world when sent through fiber.
And I
Right.
think somehow that's possible. There's so many companies around the world which are kind of solving for it, right? Like now we don't want to depend on undersea cables, which is why all these satellites are coming into play. And it's something that, given how far we've reached in technology, it's something that most people would believe is possible. Or is
The
there a big techie problem that I don't see?
the hard part is to do this in a way that's permissionless. You already have systems that do it today that are sort of singularly operated, right? Like Nasdaq or some exchange. They already try to achieve like an HFT firm in the US is already operating at this. The hard part is how do you do it in a way that it is global and permissionless, and anybody with a phone and an internet connection can connect to this kind of a market and not have to set up, a $1 million terminal with an exchange to it. That is really what makes it different.
I think that would also require a lot of like buy-in from so many countries, right? Like, no, because that's
The first thing is, can you do it technically? The first thing is, can you do it technically, which is what sort of Solana is doing today, right? So it's like if you see 400 milliseconds, that's adding what 300 milliseconds on top of speed of fiber, right? That's the gap that it's at. So of
But
course you would need countries to allow these things to operate, but first is, can you technically make them operate or not?
But to that point, my question is that should that even be a priority at the moment or is it a vanity metric to chase at the moment? The reason I say that is for real mass world adoption. What you would need is a lot more countries coming on board, a lot more companies coming on board, and therefore it's more of a customer acquisition problem versus a product improvement problem. And how they say, distribution at times is more important than the quality of the product. So do you think
Oh,
that
for sure.
kind of get excited by the idea that we're getting there, and then maybe they're like, okay, let the distribution guys do their job, let
Yeah,
the
it's
let the
basically
top
that.
guys do their jobs, and we'll just do what we're doing best, and at least we should be the best product that exists.
It's basically that. So yeah, like for example, if you look at Toli, he's an engineer. He runs this part, but he's like, I want to make this work. And then you have Foundation, Solana Policy Institute, and all the digital asset treasury companies who are taking the best product they can find and going and making the argument. I think one thing we realized is that to some extent regulations are downstream of product where you need to have someone banging on the door saying, I want to use this, I want to do this, give me the regulation. It never works the other way around, where the rules come in first and then you can use it. And so there are people
Yeah.
playing with this, on at the knife edge of what is allowed, working with regulators and saying that, look, this works. You have to make it work first. You can't go with a white paper and say that, allow this. They're like, okay, make it work, then we'll talk, right?
Correct.
So I think that's basically where it's at. But okay, so we want to build a decentralized system that's constrained only by the limits of physics of sending data around the world. That means going from the like 65,000, 100,000 TPS that's possible in burst today to over a million TPS on the layer one, right? And there's a bunch of things that are planned to sort of do that. So if you look at the 19th slide, there is so where we are today is Agave, which is the client that runs. So the name of the client that runs most of Stake today is called Agave. It's run by Anza. But if you see Fire Dancer is a client that's being built by a team called Jump, which is a high frequency trading firm. They are building a bespoke client that can do 1 million plus TPS, right? And of course, this is a client that will,
Was it
I
the
assume,
same as jump trading?
it is. They have like a crypto trading arm, and they have an engineering team, and they are building a client that can do 1 million TPS specifically designed for HFT use cases, and will probably be used by many other folks. And it's currently at 7%. There's a hybrid client at 7% stake, like it's being rolled out, etc. Then you've got Alpenglow, which is crazy. It's like three people, like a professor and two students in a university in Zurich. They wrote a criticism of Solana's consensus mechanism, and then they got hired to join in and implement it. And so they're building basically a new piece of software for how sort of Solana coordinates between these nodes that is expected to bring down what we call finality to 150 milliseconds, which is again as low as it can go today, I guess. This is like software improvements, right? So there's basically three layers on which you make improvements. The first one is software improvements, which is Alpenglow. The second one is just having more types of validator clients, which is what Tiny Dancer is doing. And then if you go to the last slide, there's two things that are happening. On the software side, you have something called basically MCL, which is multiple concurrent leaders. So if you go back to the GIF, there's always one leader, right? There's one validator, one node that's the leader. This is basically saying there can be three at a time or two at a time without conflicting, right? And so that makes you that much less sensitive to geographical latencies. And it also reduces the risk of getting captured or cornered, because three at a time are producing blocks that then merge into one. And this is like hardcore engineering stuff that I just barely understand at the surface level. And the last thing, which is the coolest thing, is something called 00, which is like basically dedicated undersea cables only for processing validator and blockchain transactions, right? And so there's this team which has realized that, okay, it's this basically from what I understand, it's a capacity utilization plus specialization problem, where they said there's so much undersea cable that's there, it's not utilized to its limit. And so they're buying up or maybe even laying new cable, which will only be used for blockchain validators. They're starting with Solana. I think they're going to do more networks as well, but only be used for these validators. And so what happens as a result is, at the cable level itself, they can write software to filter out spam transactions, obviously bad transactions, unrelated traffic, and do one layer of filtering before anything reaches the validator, right? I think they have inner circle, outer circle, from what I understand. And so this is the ultimate layer of improvement to try and make these decentralized systems coordinate better, right? And so all of this is to say that these are not static. There are like hundreds of the best engineers working on making these faster, more performant, more secure, with the vision of getting to a point where all economic activity, all like transactions can happen on these networks, right? That's largely the end vision that these teams are working towards.
Wow. At times I wish I had studied to be like an engineer or something. The world is so much more exciting, because I think when you study commerce, maybe people think this is exciting, where I can think, okay, what kind of product can you pick up from where and sell where and make money? But I think real joy in just building something which doesn't exist is just so beautiful, right?
Yeah, I mean, this is incredible stuff, right? What these folks are doing. So
Awesome. Thank you, Aditya. This really clears up a lot more questions. It definitely brings up a lot more, but I think it's great that we can take out the time at least twice every month to learn these bits and pieces, and hopefully, if we keep putting in the effort over a long period of time, we'll just keep solving all of the questions that currently exist, and hopefully keep bringing a lot more better ones, which will help society move towards efficiency, not just in finance, but practically everything else where we can see a blockchain application. Thank you.
yeah, awesome.